Ladies and gentlemen, a very good evening and warm welcome to distinguished audience, panelists, members of the media and investors across the world that are connected online. Firstly, I would like to thank His Excellency, Ambassador of Norway, Mr. Hakon Harald, for taking the time out of his busy schedule. We are truly honored uh, by your presence, sir. I'd like to express our gratitude to the chief guest of this event, Honorable Governor of Bangladesh Bank, Dr. Hasanesh Mansoor, who will be here with us momentarily. As you are aware, our country has recently achieved a significant milestone with the transition to a new government in August this year. The change has initiated a wave of reforms and transformative developments. We strongly believe that it is once in a generation opportunity for us to improve governance. Our discussion today will focus on the latest trends, policy updates, transformative changes happening in Bangladesh financial market. We will also explore the potential opportunities that lie ahead, how the country is navigating the current challenges, and strategic initiatives being undertaken. We hope the conference will serve as a platform for you to gain a comprehensive understanding of these changes and how they reshape the nation's investment outlook. Ladies and gentlemen, before I take my leave, once again, I would like to thank everyone for taking the time to be with us today, and I hope you find the discussion insightful and wish you have a productive evening. I'd like to now welcome Mr. Ifti Islam, Chairman 80 Capital, who would be your host of the program for the rest of the evening. Thank you. Over to you, sir.
Thank you very much, Asana. Well, I think we have a very rich range of speakers and panelists today. And as the Chinese say, we live in interesting times. I think we live in interesting times in Bangladesh and also geopolitically. In terms of the structure today, we're going to start with a keynote presentation by my friend Dr. Zaid Hussain, who's one of the co-authors of a seminal white paper on the Bangladesh economy, which has taken stock of what has happened in the last 15 years and also make some recommendations in terms of the future roadmap for Bangladesh's economy. And after Zaid Bhai speaks, then we will have a macro panel discussion where we'll also welcome Dr. Masroor Riaz, the Chairman of Policy Exchange, and also Professor Mushtaq Khan of SOAS we'll have hopefully a lively macro discussion, then we'll have Q&A. That will be followed by a fireside chat with Charlie Robertson about where Bangladesh fits into global emerging markets. So with that, let me invite Dr. Zahid Hussain to come to the stage and give his keynote speech. Thank you.
চলবে কেমনে? Thank you very much for inviting me. I'm describing this presentation or where Bangladesh stands today as a historic turning point. As you know, that Bangladesh recently had a political surgery, and we named that surgery as 36 July. That's 31 days in July plus 5 days in August. We are too close to history to pass a judgment on how this happened. But my take is that it was more of a fluke than a design. By fluke, what I mean is seemingly inconsequential changes, such as a court ruling on quota in civil service for freedom fighters, had game-changing consequences. It was student-led, spontaneous, and cumulative. That is, one thing led to another. changes in one thing changed everything. Now, I'm not going to go to the details of that discussion, but just suffice it to say that the state of the interim political settlement gives us one warning, that is, we grew up learning. Seeing is believing. Now I think we need to unlearn that, because seeing in social media is not necessarily believing. We have to be careful about that. The transition of this magnitude can be anything but smooth. But for the purpose of today's discussion, I think what is important is we have a new economic management team. There have been changes of players in key public and private institutions, and they are trying to reset economic management. And they have their hands full. So let me just take you through the state of macroeconomy in which they have their hands full, and the state of reforms, what the government is doing to handle or to firefight what they have inherited. So, next slide, please. Now, in the white paper, one claim we make after very detailed examination of numbers is that Bangladesh is probably, or based on many indicators, looks like we are in a middle income trap type of situation. This is not no longer lurking in the air. It has happened. And if you remember, during COVID period, there was a lot of discussion about the shape of recovery in different economies. And this came to be known as the geometry of growth. So we had this V-shaped growth and L-shaped growth and K-shaped growth recovery and W-shaped recovery. What we are seeing in Bangladesh recently, and this is based on official data, is that we had a downturn in the economy in fiscal 20, the pandemic year, and subsequently there was a significant recovery. But following that, we are seeing a declining trend in GDP growth numbers. It looks like a falling W. Goes down, then goes up, then goes down, quarter by quarter. And if you look at the other indicators, which I'm calling structural stagnation, you look at the depth of export, you look at the complexity of exports, the relationship between the change in the structure of production and the structure of employment, you can't help but conclude that there is something not working. There is a structural problem. It's not just a recession, which tends to have some automatic correction mechanisms, but it's a structural problem which is not going to correct itself unless we do something about it. And what we can do about it is to reform our policies and institutions. And if you examine the data in details, what you would notice, and this was done very elaborately in the World Bank report, the change of fabrics in 2022, that the golden age of reforms in Bangladesh was the period 1990 to 2004. Subsequently, we have seen reforms, but reforms were episodic, at times patchy, and sometimes even regressive. That is, they undid what was done before. So that's one issue on the growth side. There is a measurement issue which we have tackled in the white paper. I don't want to go into the details of that. But then there is this structural issue. And then on the next slide, please, on the macro side, the biggest problem now that the current government is faced with is deeply entrenched inflation. And here, when we did this white paper consultations, there is this general perception that the officially reported inflation rates are understated. So that's why I'm saying the data issues, previous slide please. The data issues, there is a perception problem, and I think that is moot. It is moot because even when you look at the official data, you see persistently rising inflation. So whether it is understated is immaterial, because if the official data itself is showing a big problem. And when we do the analysis, when I say persistence, what I mean is that the best predictor of inflation is past inflation. That's what I mean by persistence. If inflation is 10% today, you can be reasonably sure that next month it will probably something close to 10%, unless there is some shock. So the question now is, well, how did inflation get so deeply entrenched? Now there are global factors which ignited inflation, but there are also perverse policy responses which we saw during FY21 to FY24, which entrenched it further, which kind of amplified the inflationary forces that were already in play. And this includes monetary policy. This includes the way we try to manage our foreign exchange market. And it includes the approach we took to stabilize prices of essential items, which I'm calling the market policing approach. None of this gave us the result that were intended. Now, of course, currently there are some policy corrections that have been introduced, particularly in monetary policy. The central bank for last 2 months has tried to do what it said it would do, which is a tight money policy. We have seen some stability in the exchange rate. The exchange rate played a big role in propagating inflation in fiscal 22 in particular. But we are also seeing a continuation of the old approach to stabilizing food prices, which is market policing, which did not work in the past. I don't think it's going to work in future. So there we have, attempts are being made to correct the problem, but I think much more is needed. So that's the second area, second macro issue that the interim government has to deal with. The third area where the interim government has inherited a very severe constrained situation, that's in the area of foreign exchange reserve. Foreign exchange reserves have depleted from a peak of about $48 billion 3 years ago, now down to the gross official reserves as measured by the Guidance International Monetary Fund's Balance of Payment Manual 6, about $18-19 billion now. So there was rapid depletion of foreign exchange reserves. And my take on what caused it, of course, there were global factors, the rise in commodity prices, which increased import payments. But the reserves kept declining even after the global conditions started to improve. And there, I think the exchange rate policy that Bangladesh Bank adopted in September 2022 was a major blow to how we could get out of the situation. It worsened the already depleting reserves. And this was a very complicated exchange rate system with many different rates for importers, one rate for exporters and remittance and so on. But that was one big policy mistake that we need to learn from, system of multiple exchange rates. Now, of course, the government, the IMF program came and then exchange rate policy was reformed. The big step was taken in May 2024 when we moved to a crawling peg system and we abolished the multiplicity in the exchange rates. So reforms have started and we are seeing some results from those reforms. The end point, the end game here is to ultimately move toward a market-based, flexible, managed float exchange rate system. So that's on the external balance front. On the financial sector, we have a big problem. Many sick banks, there are some islands of excellence, which is what is keeping the trust in the system, but there are several zombie institutions which will need some kind of treatment. The government has already, Bangladesh Bank in particular, has already announced a few reforms. One very significant reform which it announced just a week ago was the tightening of the NPL recognition criteria. This will go into effect on April 1, 2025. And don't be surprised to see a spike in non-performing loans and a spike in the magnitude of under-provisioning of non-performing loans from April 1, 2025. But the reason I say don't be surprised, because that is merely a change in recognition of the problem. The problem is already there. It will only come to the surface as the new standards begin to be applied from April 1, 2025. There are several, hopefully, transformative reforms which are now in progress. And these include, already one circular has been issued, the identification of the ultimate beneficiary owners of the banks. There is a Bank Resolution Act which is now being drafted and hopefully will be done within next month and a half. And then there is a Deposit Insurance Act which is also work in progress. These would be essential for addressing the problem of sick banks. And this is part of the legal preparation that we need to try to find a resolution mechanism. And then there would soon be an asset quality review, starting with the most problematic banks. So that will give us, once we are done with the asset quality review, we'll get a better sense of the true state of the balance sheets of these six sick banks, and then figure out what to do with it. But the bad news is that we have many sick banks. The good news is that there is the work on addressing the problem is underway. It's not just talk. They are trying to walk the talk. Now, along next, please. We have, as you know, the audience here, they're well versed with the struggle that the capital markets have been having for a long time, low depth of capital markets compared to our peers. And I think there is a severe problem of distrust in capital markets, entry barriers for private equity firms, venture capital, and impact funds. The market is dominated by government securities. But there is also, now we are beginning to see some reforms, starting with the reconstitution of the Bangladesh Securities and Exchange Commission. And then there is a task force to improve, to recommend reforms for improving the governance of the capital market. And we hope that they would be able to deliver some concrete reforms which will become part of the budget for fiscal year 26. And finally, I think we have a problem of growing public debt. There is unwarranted complacence about how severe the burden of public debt is. And this complacence comes from the debt sustainability analysis of the World Bank and the IMF, which single-mindedly focuses on the debt GDP ratio and its dynamics. When you have problems with GDP data, when the growth rates are not credible, the dynamics that you see in the debt sustainability analysis, that looks very favorable in the sense that the growth rate is higher than the real interest rates, that is a little bit misleading. So if you use alternative metrics, which do not use GDP, so if you take the debt to foreign exchange earnings ratio or debt to domestic revenue ratios, the dynamics look much less favorable. One thing I want to mention in this context is the way the rating agencies do their business. If you look at the rating reports of Moody's or Standard & Poor or Fitch, and the outlook they projected, for instance, in 2022 or 2023, everyone said the outlook is stable, not just for the economy as a whole, but also for the financial sector. Subsequently, they completely missed the instability that was already incipient in the economy. And now we are beginning to see that Moody is downgrading sovereign credit rating, which I think should have been done probably 2 years ago. So just like the rating agencies missed the global financial crisis, so did they miss the macroeconomic cracks in macroeconomy that we began to see, particularly from fiscal 21 and onwards. The rating agencies' assessments are extremely vulnerable to official statistics on the macroeconomy, and I think that is something they need to take into account. That the lag between the the emergence of the problem and the recognition of the problem is too long. Now, on the fiscal side, currently the government is trying to reduce the size of the deficit, and they are revisiting their priorities. So, just to sum up on the macro, I think the bottom line is that the macroeconomy is fragile. We are driving blind because the data is flawed. But when I say data is flawed, I don't mean data is rubbish. It's not that you can just throw it away. All I'm saying that when you look at the GDP data or the inflation data or export data or even the debt data, you have to handle it with care. Just can't take it at face value. Now, we are in an unprecedented historic juncture. The cliche, they say if you set your mind to it, you can change the world. That's the cliche. But the reality in Bangladesh, we have seen that when the students put their mind to break a despotic leviathan, they did it in 36 days. And that's, I think, that's where the hope for Bangladesh is. That I think there is a fireside chat that's coming up, which said, "Will this monsoon revolution be different?" Or I could add that, "Will we be able to bend the arc of history?" We shall see. But I think there is hope. So I think I'll stop here, although I had more, but I'll stop here. No, thank you.
Thank you, Dr. Zahid Hussain, for a very insightful and very data dense presentation on the economy.